Good morning, everybody. Welcome to the National Real Estate Post. Of course, we're here with our friend Barry Habib. And before we get started, just want to let you guys know, Barry and I have been doing great webinars with Angel Oak where we've talked about how to get into real estate offices and do presentations, what to talk about, how to maximize your benefits from doing these things.
Very important right now, Frank. Very important.
Very important. We've been doing them, and we've got one scheduled for next week, Thursday, with Angel Oak again, but things have come up to where you're going to be on travel, Barry. So I just want you guys to know the webinar is still a go. We still got all of Barry's input, all of his information. It's going to be great. Don't miss it. Click the banner you see on your screen here over on your right so that you can register for the webinar if you haven't done so already, and we will see you guys there.
Oh, yeah. I'll be speaking in Charlotte, but you have all my notes. You have everything.
Oh, yeah.
So we're all golden. It's going to be really
gold.
good.
Yeah, it's going to be great. So let's open
Plus,
this.
the way you handle yourself is always amazing.
You know, well, I've learned from the best, Barry. I've learned from the best. So let's start off. Last week, you made a very interesting call, and you pretty much nailed it. Why don't you tell us what happened last week? And then
Well, yeah, I'm really proud. We had been calling the market pretty darn good and had set a crazy target with most people thought of 1.98% of the 10-year Treasury a while ago, and yields have been drifting. Now, we didn't hit that target, but we came pretty darn close. So considering we were, well in the 230s when we made the call, to drift all the way down to 2.01. So just missed it.
Just missed it.
What I'm really proud of is that when we hit that level, we thought that was the bottom, did not like the signals, told all of our subscribers, lock here. Before, had all kinds of time because there was nothing really going on. It was a quiet day. Nothing really happened on Friday.
But as you did it.
See this week, yeah. And we said that our target is we think it's going to go from 2.01 to 2.18. Well, isn't it amazing? That's a long way for yields to travel in just 3 days.
Yeah.
And it's
wow.
2.18. Is right on the mark. As we're recording, that's exactly where it is. So pretty proud of that. Now, this is an important threshold here. It's at a pivot point. If we break above 2.18, man, we've got to kind of hold on to our lock cards here because I think that we'll see yields move higher still from here and mortgage bond prices will decline. But if 2.18 holds, well, there's a very good chance that yields can drift lower. There's a lot of room for them to do so. And that could help us out a little bit here. So, we've seen as a result of the low yields that we've had, refinances really soared recently. And so have purchases and refinances, both doing extremely well, taking advantage of the low rates.
Yeah, overall, refis are down from a year ago, et cetera. But yeah, they've had a nice bump from the low rates. So that's good.
You're 100% right. In fact, refinances, even with this recent surge, even with the rates as low as they are, because the survey that we're talking about from the MBA takes into consideration last week's rates, which was the absolute low,
right?
Still down 35% from last year. And you're 100% right. You were one of the early ones to call that, Frank. So you are absolutely correct.
Yeah. So definitely got to stay on top of that purchase market. Let's talk about the Fed, Barry. You had some thoughts on the Fed.
Let's talk about the Fed.
Yeah, let's talk about that.
Now, we know we've got a meeting coming up next week.
Right.
And I don't think the Fed's going to do anything.
Why's that?
Because I think that they are, first of all, not going to touch interest rates. And they're very fearful of two things. They're fearful that the economy is fragile, especially in light of some of the storms that have impacted Texas and Florida. And those of you watching, boy, oh boy, our thoughts are with you. We're hearing a lot of stories from our subscribers. So we've done all we can to help here at MBSI, I'm sure, as you guys have. So we want to certainly put a mention out to you guys and say we're thinking of you. But because of that, some economic activity may slow and the Fed may be more reticent or may decide to kind of push things off. They love to kick the can down the road. Now, here's what we think that they want to do.
Okay.
They want to, next week, I think, at least announce or start the reduction of the balance sheet, otherwise known as quantitative tightening, the opposite of quantitative easing.
Got it.
If they did this, then it's my feeling that it should have a gentle, but it still will be an impact on yields, meaning it will push them higher because they're taking the biggest buyer and making them buy less.
Right.
I'm going to tell you something that a friend of mine who I really respect, I consider him to be one of the smartest guys out there in the bond market, so I've got a tremendous amount of respect for him.
Okay.
His name is Lacey Hunt, and you can look him up. He's at Hosington. And Lacey, he tells me that he feels that this unwinding of the Fed's balance sheet, based on his historical data and his information, will not impact long-term rates.
Really?
In fact, he thinks long-term rates continue to potentially go lower, which I thought was very interesting. So while I initially didn't see it that way, I've got to tell you, I've got so much respect for Lacey that we could be in for low rates. And boy, if you look at the trend of yields declining, and one of the things I've always said is what the Fed doesn't get is it's innovation, it's technology that's keeping costs down.
Right.
I mean, look at what happens because of that, and that lower inflation keeps driving interest rates lower. I mean, Lacey could be right that we could be in for even lower rates ahead. So that'd be very interesting.
Well, that's good. I mean, that's good news, because that type of rate environment is going to definitely keep the industry as a whole, the real estate and mortgage industry as a whole, just moving and going and churning, which is good for us in the relatively near future here. So that's good. It'll be interesting to see.
But here's the other thing, brother, is that we really still have to focus, as you've been preaching, on the purchase side.
Sure.
Because I've got to tell you, the purchase side is going to remain really strong for a while. Now, at MBS Highway, what we do is we have every single county in the country, every single one of them. And we have forecasts for the next 15 years for real estate. We've got the job market picture. We've got affordability. We have every county, how many homes are up for sale, and what inventory levels are doing. And in analyzing the vast majority of areas in the country, we continue to see a lot of strength going forward in real estate. It is, the job market's strong, earnings are strong, the inventory levels remain low, and the demographics, which is the thing that people don't get, is you have to look at demographics, because that's etched in stone. You can't change that.
Right.
People that were born 33 years ago, that's happened. That's done. So like it or not, these people are coming into the market.
Right.
And they're going to come in larger and larger and larger numbers every year. So the demand is going to increase. The supply is going to remain tight, because builders can't put up homes like crazy. They can't overstock the housing market.
Right.
The reason why they can't do that is because of labor shortages. They can't get banks to lend on spec as easily because banks got burned, and it's just not there. Now, especially think about this, brother, with what's going to be going on with rebuilding in Texas and in Florida.
Yes.
It's even going to exacerbate the labor shortages.
Yes.
So housing is going to remain very tight. Supply is going to remain very tight. While demand is going to increase. Anybody who's taken Economics 101 knows what that means for prices.
Right. And so one of the things that could derail everything, pointing to, everything you're describing, saying, hey, real estate's going to kick butt here for a while. The one thing that could certainly, potentially derail that is if rates did shoot up. But what we're talking about here is that now we've even got the rate environments looking like perhaps it's going to stay nice and low the whole time as well, which is going to, fuel this great mode, or this great real estate environment, and continue to do well for a while here.
You nailed it. You're 100% right. One of the things that could become very problematic for us is if interest rates moved up in a very meaningful or a significant way.
Right.
So, as we know from history, what drives interest rates? Two things: credit quality and inflation. Those are the two things that drive it. So credit quality, as we just got the CoreLogic numbers, that continues to decline. Homes in foreclosure, 0.7%. When you take into consideration homes without a mortgage, less than 0.5% of the market's in foreclosure. That's, again, exacerbating the tight supply. In addition to that, when you look at transactions that are seriously delinquent, that is 1.9%. That's a very low number, and it compares to last year being at 2.5%. So that was already a very low number. So seriously delinquent is 90 days or more delinquent. Okay, so this is a very good environment, a very, very low number. It's a great time for credit quality. Now, as far as inflation goes, we talked about that. Innovation, technology, inflation is dropping. Central bankers are trying to create inflation, and they can't do it. So it doesn't appear that interest rates will have the ability or be pushed higher in a meaningful way. Of course, they're going to vacillate. Of course, they're going to go up.
Yeah.
But will we see a 4% 10-year Treasury yield anytime in the future? No. Will we see a 6% mortgage rate? No. Will we see rates slightly remain under 5%? Very, very, very strong probability that continues to happen. And that's just a breeding ground to buy homes.
There you go. Well, Barry, thanks for your insights, man. Really appreciate it.
It's my pleasure.
All right. Well, you guys get out there and make things happen. Things are looking good for you right now. So you guys have a great day. Leave us your comments down below. Barry, answer some if you can. I know you're busy. So
I will.
If you guys got questions for Barry, put them down below. You guys forward and share this video. Subscribe on Facebook. There's a link up above on our website. There's a big orange button up there on your right-hand side. and you'll get more meaningful, wonderful videos just like this. We'll see
I
you
wanted
later.
to tell you how handsome you look with your glasses.
I am trying to mimic you. Look, I'm even trying to get the gray in there. I don't know. So. All right, my friend. Thanks a lot.
Bye.
Bye. See you guys.